I'm just going to introduce the keynote speaker, and then he'll take over. Professor Bart Lambrecht will be very pleased to have you to this conference as a keynote speaker. So I'm just going to make a brief introduction. Professor Bart Lambrecht is a professor of finance at Cambridge Judge Business School and director of the Cambridge Endowment for Research in Finance. Previously, he taught at Lancaster University, and he has held visiting positions at the University of Calgary, UCLA, and MIT Sloan School of Management. He received a BA in Applied Economics from the University of Antwerp, and an MPhil in Finance and a PhD in Economics from the University of Cambridge. Professor Lambrecht is a fellow of the CEPR. He's a former editor-in-chief of the Journal of Corporate Finance, a former associate editor of the Financial Management and the Review of Finance. He's currently an associate editor of the Journal of Banking and Finance and a member of the editorial board of the Journal of Business, Finance and Accounting. He's the founder and lead organizer of the annual Cambridge Corporate Finance Theory Symposium. So Professor Lambrecht has published papers on a variety of topics in corporate finance. His earliest work studies the role of strategic behavior and competition for valuation exercise of real options. Related work examines the role of product market competition and human capital for corporate capital structure. Some of his papers study the timing and dynamics of corporate restructuring and explore how these restructurings are influenced by agency or strategic considerations. Professor Lambrecht also developed two theories that generate the celebrated Lindner dividend model. One theory argues that Lindner-style payouts moving results from managerial risk aversion and habit formation, whereas another theory shows that this type of payout and income smoothing can also result from asymmetric information and learning between inside and outside shareholders. His most recent work focuses on the dynamics, and that's what I think is going to be the focus of this presentation, on the dynamics of financial policies and group decisions in private firms and partnerships. His research has been published in leading academic journals, including the Journal of Finance, Journal of Financial and Quantitative Analysis, Journal of Financial Economics, the Review of Finance, and the Review of Financial Studies. So without any further ado, I introduce Professor Bart Lambrecht. Thank you.
Okay, thank you so much for this kind introduction, and thank you for inviting me. It's really a pleasure to be part of this conference, and it makes it even more memorable given that it is my first conference since the lockdown, at least conference attending in for real. I should start off by saying that this is joint work with Shiki Chen. Shiki is currently at the University of Cambridge, but she will be joining the University of Lancaster later this summer. And as the title suggests, so this is all about trying to explain financial decisions within private firms. Now, a lot of research has been done on corporations. Think about corporate finance. It's traditionally been focusing on corporations, but actually private firms vastly outnumber the number of corporations, and yet there has been relatively little research on that. Private firms come in all shapes and forms, so you can have private limited companies, there are various types of partnerships, limited liability companies and so on. Sole proprietorships, they are everywhere really, and they are the backbone of most economies. Now, there are two key characteristics of private firms that this paper is going to focus on. The first one is that private firms are owned by a small group of investors typically. So we are really focusing here on the small private firms. I know there are some big ones out there too, but you know, the standard kind of small businesses. Unlike corporations that literally would be held by thousands of shareholders. So that's really a crucial difference. And so the question is then, you know, how are these small investors, this small group, perhaps half a dozen, how are they setting policies? And they may often have very different kind of preference structures. So that's one key aspect we focus on. And think about corporations. They usually have a separation between ownership and control, right? You have a management. In private firms, often the owners themselves are running the company. The other key difference is that private firms are not traded on a stock exchange. So you can't kind of just easily buy or sell your shares. You're pretty much locked into the company. And so you're holding a illiquid asset. It might be possible under certain circumstances to try to sell it to the other investors, but it's not straightforward. The other thing is that for most private investors, their stake in the private firm would be a huge stake of their wealth. So they are highly undiversified. Unlike, again, you know, if you invest in public corporations, you can have a portfolio of 20, 30, 40 shares, as many as you like, or indices. So here, you've got something where you've got a small group of people, highly undiversified, and they are locked in together in this venture, so to speak. How are they going to run the financial policies of the firm? What will the capital structure look like? How will they kind of agree in terms of their preference structure? Now, there is some literature in, and I think it comes from sociology or other areas, which have looked at how, for instance, groups act compared to individuals. And there are like two competing hypotheses from this kind of literature. One would say is that, well, you know, groups are just like an average of the individuals. So it's called kind of the diversification of opinion hypothesis, of the diversification of preferences. So you kind of have a mix of what people want, and it's just some kind of a weighted average. And there seems a lot of empirical support for that hypothesis. Yet there are some things that this hypothesis can't explain. And that seems to be the fact that often the average group is more risk averse than the average individual in high risk situations, whereas the average individual is often less risk averse than the average individual in low risk situations. So at the extremes, the diversification of opinion hypothesis doesn't seem to kind of explain things so well. So you get this polarization sometimes, which is more standard to what would be called the group shift hypothesis, whereby people with extreme beliefs, extreme preferences dominate, yeah, and push through their will. So what we are trying to explain in this paper now, and this is an applied theoretical paper, and we'll come up with some empirical kind of predictions, which empiricists can test, but this is primarily an applied theoretical paper, is we'll try to come up with a theory for the investment, financing, and payout policies of private firms that are owned by a small group of investors with heterogeneous risk preferences. So some are going to be more risk averse than others. And they can't trade their claim. And that's important, because if you can trade your claim and you find that things are getting too risky for you, well, perhaps you just sell off a little bit of your holding and put it in cash. And you could recalibrate your risk profile that way. But here you can't. Your fortunes are tied into this company. Now, so what are the objectives? So we try to come up with a model for these financial policies. Investors are all risk averse, and they are going to maximize the expected lifetime utility of their consumption they are going to get out of the firm, so the payouts they are going to get. There's going to be a lead investor, and he will kind of control access to some superior technology or project that generates a superior Sharpe ratio compared to what the other investors have access to. And really, the driving determinant here in these projects is the Sharpe ratio, which is the excess return scaled by the volatility of the investment. Now, investors will then join the project, but because the lead entrepreneur has exclusive access, he will be able to extract some rents from these other private investors. And we'll show that basically he can charge almost like a joining fee, so to speak. So the shares kind of are being sold at a premium, so to speak, to these outside investors. The way the synergies are distributed is not crucial for this paper, but we believe that this is kind of a natural assumption to make. Now, the key dilemma that these investors have is they need to agree on a unique investment and financing policy. You know, you can only have one capital structure for the firm. And each different investor would probably want a different one. So what is ultimately going to be the prevailing capital structure? And this being said, what firms can do is they can tailor payout to individual investors. You could give each investor a different contract. And that's actually what we will allow to happen here. We could, of course, have said, oh, you all have like the same shares, and your dividends are going to be proportional to the number of shares. We actually do something more general. You could basically design the contract to each individual investor, and we'll come up with standard shares, but only for a very specific utility function. Actually, for lock utility, if all investors have lock utility, then we end up with the kind of standard share contracts, which are linear in the firm's net worth. In all other cases, you get contracts that are going to be highly nonlinear. And so we'll kind of look what this optimal corporate liability structure will look like for private firms. And we'll try to see a bit more what is the nature really of this illiquidity and how is it going to affect decision making. So what are the main results? Well, first thing we kind of were grappling with is how would you ideally want to set the capital structure decisions within a firm like that and the investment decisions. And we did kind of the following thought experiment. You know, suppose you've got, I don't know, 3 investors together, and they kind of have access to this firm. What you could say is, well, if each of them could individually run the firm, or like a mini firm within that firm on the basis of the money he's put in, so if each put in, say, 1 million, what if I could run my 1 million the way I wanted? And I have like a mini firm within the firm. Of course, in practice, this is not possible, but hypothetically, we could kind of construct something like that. And then you could have 3 mini firms where each firm would have a different risk profile. The investor who is less risk averse may go for higher leverage, whereas the other ones perhaps for lower leverage. And then the aggregate kind of firm policy would just be the sum of these mini firms. You add up all the liabilities, the assets, and you'll get your capital structure. And then you could also give the payout that is generated by each mini firm to each investor. And that would, of course, be the ideal world. Yeah? Now, in reality, the world doesn't work like that. You can't just start running mini firms. Also, contractually, you need to write contracts that are written on the firm's total assets or the total net worth. You can't just say like, oh, you own a fraction of that machine and half a building or whatever. You really have to look at a pool of assets and you write contracts on it. Because clearly also what you would have is, if you construct these mini firms, some mini firms will do better than others. So that means that actually your shareholding within the whole firm is going to vary over time. It's not like that we all each have 1/3. No, actually, if you allow people to run their own mini firm, some will do better than others and some will therefore increase their shareholding. And again, contractually, you can't kind of have contracts whereby the shareholders dynamically start varying. So we then have to start figuring out, okay, is it possible to kind of come up with policies that replicate this ideal scenario? And we actually show that it is possible. It's possible to basically put in place something that looks like a social planner. And this social planner is going to maximize the weighted average lifetime utility of all these investors in the firm. Crucially, the weights that are going to be given to each investor are going to depend on how much the investor has put in the firm, but also on his risk preferences and things like that. And so what do you then find? Well, what we actually find is that you will get, yes, a unique capital structure policy, but it's going to be dynamic. Rather than having like a constant leverage target, which actually we show each individual investor may want to have a constant leverage target. Once you have a group of investors, the leverage target starts fluctuating dynamically. In particularly, if the firm starts doing well, it will start levering up, buying more assets on the basis of borrowed money. If, on the other hand, things go badly, it will start retiring projects and use the proceeds to pay down the debt. And therefore, the leverage will kind of become pro-cyclical. And it kind of reflects the fact that the group's risk aversion will also be varying. Each individual investor has a constant level of risk aversion. It's innate. You're either very risk averse or you aren't. That doesn't change. but the risk aversion of the group will actually change over time. Particularly, again, if this firm is doing well, the group will become less risk averse, as a group that is. If, on the other hand, the firm is doing badly, the group will become more risk averse, and risk aversion will start spiking. Now, the investment and payout and capital structure policy is unique. There is only one. If you want to really come up with the optimal contracts for the individuals, you have to tailor-make the contracts to the individual. A more risk-averse individual will have a different type of contract in the firm, claim on the firm, than a less risk-averse person. And what we actually show is that the most risk-averse person will have like a strictly concave contract. So, yes, your claim goes up in net worth, but it tails off. It looks, you know, it actually looks like preferred equity or possibly even a bit like debt. The other investors then subsequently have contracts that look more like preferred debt. It's initially convex in net worth, and then it becomes concave and levels up to a max. So the claim you have on the firm has a cap. And then there is the least risk-averse guy. He's basically like the residual claimant. He gets very little or nothing if the firm is doing badly, but if the firm is doing really well, he's going to get all the upside. And that's kind of the optimal contract or liability structure that you get. It's like a mix of debt, which is a prior claim, because there is also debt or cash in our model. Then you can have preferred equity and equity. And why do we have this optimal liability structure or capital structure that looks like this? Well, it's really a way to accommodate people's risk preferences and the fact that they can't calibrate their risk preferences to changing environments. They are locked in the firm, so rather than being able to buy and sell shares in the firms, we've got to have contracts that somehow dynamically try to increase or decrease people's exposure towards the fortunes of the firm. So that's like, in a nutshell, the key results. Now, as I said, one of the big insights we have is that people's optimal kind of individual policies can be replicated at a firm level by a social planner. And that's kind of important we have something like that, because obviously people can't just do all their own thing. You need to have someone in charge there, or a policy in charge that runs the firm. And so, as I said, all you need to do is maximize the weighted lifetime utilities. The key thing then, of course, is what are the weights? How much weight do I put on investor 1? How much weight do I put on investor 3? And these weights basically can be determined by, in our model, people's participation constraints. And that will mean that, you know, when people join, they need to be at least as well off from joining the firm compared to what they can get outside with their money, kind of the return they could achieve elsewhere. These utility weights are not linear in people's capital contribution. It's not because you put in twice as much money that you get twice as much weight. That's only the case, again, with lock utility. And that's the way we traditionally would think. If you have put in twice as much money compared to someone else, you should have twice a stake. That's not what happens here. It only happens, as I said, when everyone has lock utility. Otherwise, things are highly nonlinear. The other thing I also should mention is that when people join, they will actually have to pay a premium on the shares. And that's basically from the fact that the guy who controls the access to the project or the technology can extract some rents. And so what happens is when people join, there can be some redistribution of wealth. But you may say, well, why would someone be willing, you know, if I put in $1 million and in the end my net worth claim in the firm is only 800,000 and 200,000 has actually been transferred to my partner who kind of has access to the project, why would I want to do that? Well, I'm happy to do that because although my net worth has gone down, I now have access to an asset or a firm that will give me a higher expected return than what I could get elsewhere. You know, to take the extreme example, if I only have access to a savings account, which currently gives me almost 0%, I'll be quite happy to invest $1 million in a firm and only get a net worth of 800,000 in a firm that perhaps will give me a 15% expected return. Yeah, so you're giving up some money, some wealth, in order to enjoy later down the road more growth. We'll also, and that to some extent locks in investors in a private firm, because the moment I've paid this upfront fee to my partner, exposed, I will not want to get out anymore. Even if I could take my money out and ask my 800,000 back, I'm going to be worse off now than before, because I started off with $1 million outside the company. I put my $1 million in the company, I got 800,000 of net worth of equity. If I now liquidate my position, if I could do that, usually you can't, because the money will be used to, buy machines, whatever. But even if I could, I wouldn't want to get out anymore. So this is, in a nutshell, the results of the paper. It links in with a literature, on a number of literatures. So there are some recent papers that try to look at how groups make decisions. These papers tend to focus perhaps a little bit more on voting protocols and things like that, which do not feature in our model. So actually with the voting, typically what you have is it's the majority that rules, right? If I have 51%, I've got control, and everyone else kind of just has to accept it. In a way, perhaps if you are working in a firm with 3-4 investors, it seems less likely also that you kind of just vote, and that, say, if you have 3 investors, 2 investors can just dominate everything and leave the third one completely in the cold and have no say. I don't think that voting is the way how things would be run. So in our model, there is no voting, and actually voting would lead to an inefficient outcome. Certainly for the guy who's in a minority. Perhaps the majority may be better off because they might be able to perhaps expropriate that third guy, but it's hardly kind of a good basis for a partnership when you start up a firm. So in our model, really, all parties kind of have an influence on what is being done in the end. There's also a small literature on entrepreneurial finance, which looks very much on the idea of smaller firms and the illiquidity of having shares in small firms. The paper uses continuous time methods, so it links in with some literature on dynamic continuous time principal-agent models. But in these models, typically there is only one agent, one principal and one agent, and the agent is meant to act on behalf of the principal. So there isn't really this idea of having a group. There is a very old literature that was on partnerships and syndicates and how they share risk. And then finally, there is an asset pricing literature on asset pricing with heterogeneous agents, heterogeneous preferences, heterogeneous beliefs. Key difference in that literature is that people can trade with each other. You can trade shares with each other, and that's your way, basically, of calibrating your risk. The contracts would just be exogenously given. They would be standard kind of asset-to-bro securities that are being traded. Here, the contracts are being endogenized, but people can't trade. So let me get into the model. So I hope, even if you get lost now in some of the technicalities, that I've managed to convey like the broad story. And I will get back then to the key conclusions again at the end. So what I'll start off with first is just a single investor firm. Suppose that, say, there is only one investor, and he or she could run the company. Let's call him investor I. Now, we have in our model basically assets that kind of are the returns of which follow an arithmetic Brownian motion. So think about it as normally distributed returns. There's like an expected mean, and there's a volatility, sigma. At the same time, the firm can also borrow money. If it borrows money, then basically it's going to pay the risk-free rate R on it. If D is negative, that means actually that the firm has a net cash position, because D here is basically net debt, the difference between debt liabilities and cash. The debt is going to end up being risk-free in our model, so that's why we can just have the risk-free rate. And it's risk-free because actually investors will be constantly rebalancing their projects according to how risks unfold. And if things go badly, they will basically start shrinking their asset base and converting it into cash or reducing the debt. We then have a standard kind of balance sheet equation whereby, yes, the firm's assets must be equal to the debt plus the equity capital. So W here is the equity capital, the firm's net worth. Now, how is the net worth of the firm going to evolve over time? Well, it's going to be, the changes in net worth are going to be determined by the changes in the asset base, minus the changes in net debt, minus whatever you're going to pay out in terms of consumption. Yeah, so this is here the consumption I'm taking out of the firm, and that's money that is paid out and consumed. Basically, if I then plug in here my processes, that gives me the dynamics of my net worth over time. And you can see that basically it depends on all these parameters, and then here also on these shocks, these stochastic shocks that the firm is experiencing, shocks to the assets. What are the key decision variables that the firm will have to adopt? Well, it will have to decide basically on its investment policy. So how many assets does it want to have relative to its net worth? So that's the asset to net worth ratio. And how much does it want to pay out? These are the two decisions. And you will wonder, what about the capital structure decision? Well, actually, through the balance sheet equality, capital structure comes from it, because once I've pinned down assets to net worth, that also will determine how much leverage I have. Yeah? So in essence, you only have 2 degrees of freedom. You determine how much you want to invest, how much you want to pay out, and then your capital structure policy is just a way to implement them. How much do I now need to borrow in order to make the investments I want to make and pay out as much as I want to pay? So it's kind of a residual policy. As I said, investors are all risk averse here, and we assume kind of a standard kind of power utility function, so constant relative risk aversion, with investors having a risk aversion coefficient gamma. And the investor has a subjective discount rate rho, which kind of reflects the time preferences. So in the standard kind of, and this is very much the Merton 1969 kind of setup that I'm using here. So this is kind of similar to a portfolio problem, the Merton kind of 1969 portfolio model. You kind of maximize your expected lifetime utility. As I said, the crucial parameter here is the Sharpe ratio. And ultimately, what are your optimal policies? Well, your optimal asset level is just a constant multiple of your net worth, where this constant multiple is just determined by the Sharpe ratio divided by volatility divided by the risk aversion coefficient. So that's going to determine then also your debt level. Your debt level is just basically a multiple, a constant multiple also of net worth. And you can show that basically if you are less risk averse, you will want a higher debt level. If the assets are less risky, you will also adopt a higher leverage ratio. And also, if you have a higher Sharpe ratio, you will also adopt a higher leverage ratio. I should say that taxes also pop in here, because these parameters here, after-tax return, these are after-tax parameters. And if you tease out taxes, what you can show is that higher taxes will also increase your leverage. So it's somewhat similar to a standard trade-off theory of capital structure, except that the key trade-off really is determined by risk and return here. Taxes and bankruptcy are more at the margin, and we don't even have bankruptcy costs here because the firm never goes bankrupt. So this is kind of the optimal policy that a single investor would want to adopt. I want to adopt a constant book leverage target, 60% or 30%, or it could be negative. I don't want any debt. I just have a, cash and assets, risky assets. And then I will have also a constant payout ratio. So each year I will pay out perhaps 3%, say, of my net worth. So a fairly standard policy. That's what an individual investor would want to do. The problem now is, as you can see, both the consumption policy, payout policy, and the leverage or investment policy depend here on the investor's coefficient of risk aversion. So someone, say we are with two in the company, I don't know, say me and Mark, and suppose I'm more risk averse than Mark. Mark may want a very high leverage ratio. I may want a low leverage ratio. So you can immediately see the tension here. We are with two in a partnership and ultimately we'll have to agree. So how are we going to go about it? Well, so in general, we are going to have here these n investors, and they all have a different coefficient of risk aversion. We just assume here that they are ranked from 1 to n, with investor 1 having the lowest risk aversion. They all have the same subjective discount rate. The Sharpe ratio, well, investor 1 here, we assume he has a superior Sharpe ratio, and everyone else has the same Sharpe ratio beta. You could inverse that in any way you wanted. It's not essential, but it seems like, you know, a plausible scenario to work from. Now, investor 1 is going to control access to this precious technology, and we assume that and other investors obviously will want to join him because, you know, they can generate a higher return by getting a piece of the action. That puts that investor in some bargaining power because there is a synergy here. Now, for simplicity, we are assuming here that the lead investor has all the bargaining power, and he will basically just make an offer of the stake that the investor can have in the company, and this W tilde here is the stake that the investor I will have in the company. That stake is going to be lower than the money that this investor is going to put in. So basically, I'm buying my stake at a premium. I put in 1 million in the company, but I only get a net worth of 800,000. And if it is just me and Mark puts in 1 million, I put in 1 million, if he is the lead investor, he may end up with net worth of 1.2 million, and I end up with a net worth of 800,000. Again, we could do the sharing rule whatever way you wanted, but it seems like a plausible way. But that obviously means that from the start here, there is going to be a redistribution, yeah, in terms of net worth. Then, okay, each of us would run, hypothetically, say, this mini firm. So, say, Mark, say, adopts a leverage ratio of, say, 50%, and I'm going to adopt a leverage ratio, say, of 20%. And that would be driven here by this kind of asset to net worth ratio. And each of us may also adopt a different payout policy. And so it would be a bit like we each have a mini firm, or we're running like a portfolio, each a portfolio with a bigger portfolio. And then ultimately, we could track how our mini firm is doing, a bit like how our mini portfolio is doing. And that would be here the process for our individual net worth holding. And you can see that it depends on the coefficient of risk aversion. So say if Mark is less risk averse than I, he will have a higher drift in his net worth process, but also higher volatility. But on average, probably his mini firm will grow faster than mine, particularly if the economy is doing well. We are both subject to the same economic shocks. And that means that basically the share in the overall firm we have is going to dynamically vary over time, with possibly the less risk-averse guy taking a bigger and bigger share over time, in expectations at least. Now, this is ideally what we want to do, but that is not going to work in practice. We can't just run mini firms. And also, what is this contract? We need to have a proper contract here, because it would be very hard to keep track of our individual performance. That's just a hypothetical construct. The question is, can we actually replicate policies that regenerate this ideal? And what we are going to do, what we can prove is, yes, we can actually replicate these ideal policies for each of the investors. How would we go about it? Well, you can prove that these policies can be replicated by a social planner. And the social planner, what he would optimize is the expected sum, weighted sum, of the lifetime utility of all the investors. So here, this integral is just the lifetime utility of investor I, and we are summing this up across investors, and each investor gets a particular weight by the social planner. the weights will add up to 1. As I said, with lock utility, you could interpret them as ownership shares. But in reality, for general other utility functions, they are going to be quite different from the standard concept we have of ownership shares. And here you then obviously get here now the net worth of the firm, which is now going to depend on how much money I pay out to all investors combined. That's why we have the sum here of, and I don't know whether, yes, you can see my pointer. The sum of the consumption. Now the key thing, this allows you basically to derive the optimal consumption and the optimal kind of investment policy. What it doesn't allow you is yet to identify these lambdas, because they're kind of exogenously given. So how do we find these lambdas, these weights? Well, these weights are just going to be the solution to the participation constraints. So under the assumption here that the lead investor has all the bargaining power, he will offer basically policies and net worth stakes so that the lifetime utility that the investor gets from being part of the firm equals the lifetime utility he gets if he were to be outside the firm and run his own firm, admittedly with a lower Sharpe ratio. Okay? And then obviously there is a total net worth constraint which says that the sum of the net worths need to add up to the total net worth. Now once you solve all of that, we can actually get, and this is the last technical slide I'm going to show you, but it's all closed form. We can actually get explicit kind of solutions and explicit contracts, explicit claims. So what is the optimal asset to net worth ratio for the firm? Yeah, which is also going to pin down the leverage ratio. Well, it's going to be a weighted sum of the individual optimal asset net worth ratio. So if you remember this here, I don't know whether you can see my pointer, but this is basically what we previously saw. This is what the optimal kind of asset to net worth ratio would be for investor I. We are just going to sum these up across all investors and weight them. The interesting thing is that these weights, these phi's, depend on a variable z. And z can interpret it as a log transformation, more or less, of the wealth variable. So it's kind of monotonically increasing with wealth. So crucially, therefore, the asset to net worth policy or the capital structure of the firm becomes time varying. And it depends on how well this firm is going to do. Yeah? So we no longer have like a standard kind of constant leverage target. The leverage target is going to fluctuate all over the place, depending on how well the firm is going to do. And it's going to be, as I'll show in a second, procyclical. The payout that each investor gets, and that's like the claim really he has on the company, is a function of the total wealth of the company. And it's a fraction, but again, it's a varying fraction. In fact, you can see it here as a fraction of the net worth stake that the person has in the company, just as before. But it depends on this lambda, and we show for a specific set of lambdas, the one that satisfy the participation constraints, we will exactly replicate the cash flow stream that the investor would have had if he acted on his own. So basically, if you remember what I previously showed, this was exactly the same kind of formula, except that here now it depends on a particular lambda. But I can set these lambdas, these weights, in such a way that basically I'm going to replicate exactly everyone's cash flow policy. So you will get exactly the same cash flows from being part of the firm and being subject to this firm policy set by a social planner, compared to the policy, the cash flows I would get if I could run my own show, so to speak. Yeah? And that's why basically we've got this equivalence. Now, some of the properties of the solution. So as I said, the net worth ratio, the asset to net worth ratio is procyclical. So in good times, we will invest more and borrow more, therefore, to finance the investments. In bad times, we will retire projects and use the proceeds from retiring those projects to pay down the debt and build up cash. So typically, therefore, what you would have is that when you have a startup, net worth will be small, and typically the net debt ratio may be negative. Actually, you don't have that. You start off with a lot of cash and some investment in risky projects. And initially, you may be burning a bit through the cash, but then if ultimately your projects take off, then you will start investing more in them. So you will start depleting your cash and ultimately start borrowing, taking on a net borrowing decision if things go really well. Now, what about the group's risk aversion level? Well, we know that each individual has a constant level of risk aversion, but the group as a whole has a time-varying risk aversion level. In particular, if Z goes to positive infinity, which means wealth goes to positive infinity of the firm, the net worth goes to positive infinity, then basically the risk aversion of the firm resembles the risk aversion level of the least risk-averse investor. So basically the firm starts behaving almost like the least risk-averse one. And the way to understand that is if you think back about this hypothetical construct where we have these mini-firms, what will happen is if the economy is doing really well, the least risk-averse guy, his portfolio, his mini-firm is growing much faster than everyone else's. And the longer this takes, the more he will start dwarfing everyone else. So basically the firm starts pretty much resembling the mini-firm of that least risk-averse guy. And you therefore become much more aggressive in your policies as a firm. On the other hand, if the firm is losing money, net worth is being drained, and the least risk-averse guy, he will have invested primarily in cash. So his firm will have been almost like a cash pile. Everyone else will have been losing, and now it's the least risk-averse guy who is dominating the firm because he's relatively bigger compared to everyone else who's been losing. Yeah? So that's the way to understand what's going on. Now, if you now look at the contracts, this is here an example of 4 different investors. So what you can see here is they have 4 different coefficients of risk aversion, and the solid line here, which is the concave curve, is the investor which has the highest level of risk aversion. And you can see that his net worth stake in the firm, so here you've got net worth, and this is his stake in the firm, the W tilde. How much do I own of the net worth? And you can see that this guy, as the net worth of the firm goes to 0, the first dollar of net worth goes to him, because this is like a 45-degree line. And then as the firm starts accumulating more and more net worth, his kind of claim will level off to a max. Yeah? What about the guy who's the second most risk-averse one? That's basically the one here who has the orange dashed line. So it's initially a convex curve, and it becomes then concave, and it's going to also reach a cap, but the cap is now higher than the most risk-averse guy. So he's going to get a higher stake and a higher maximum payout. And then you've got the third guy. He has initially again convex, and then again this is also going to go to a cap. Although it doesn't look like that, it will actually converge to a cap too. The only claim that isn't going to a cap and that is unbounded is the claim of the least risk-averse guy. He initially has almost 0 stake in the firm. If the firm really goes down the drain and all wealth is depleted, it means his wealth will be pretty much gone. As the firm starts accumulating wealth, gradually his claim starts kicking in, and he's the one who has the residual claim. So if the firm is doing really well, he will capture all the upside or most of the upside. And so that would be like, say, the lead investor here. These kind of claims basically tailor to people's risk preferences. It's a way to kind of accommodate the heterogeneity in risk preferences, given that people can't buy or sell their claim in the firm. What about the Lambda weights? Well, you can see here that in general the Lambda weights are increasing in the net worth I put in the firm. But it's not linear. It's raised to the risk aversion coefficient, which could be a number different from 1. Now, this is here the Lambda weight, and here as a co-investor, if I put in 0 wealth, I will have a zero weight. That makes sense, right? On the other hand, the lead investor, if he puts in zero wealth, he will have a stake still in the firm. So even if the lead investor, the entrepreneur, even if he's penniless, he will still have a claim, because he's the guy who has the ideas, he's the one who has the technology, he has exclusive access to his ID. So to give people kind of a share of the action, he's going to get this upfront premium, this joining fee from these other guys. And that's basically captured by the sum of these bits here. These are the sum of these fees. And that means that he will have a net worth stake in the firm, even if he has no money. Yeah? This here just shows you that basically each individual investor basically will have to pay a fee. I have, say, an amount WI0, but in the firm I will have a stake that is less. So I'm buying the shares at a premium. The lead investor, obviously, he's going to capture all these fees, and that's going to enhance his net worth. You can immediately also show that once I have invested in the firm, as a co-investor, I will not want to leave anymore, because I have given up money here in order to get access to this superior asset that will give me a higher return than what I can get outside. So it would be crazy for me then to try to pull out my money. If I could sell this stake in the market, it might not be an issue, but here I could only give it to these co-investors for the face value, the book value. This is here a numerical example that basically shows us the key results for two polar cases. One is here beta equal to 0, which means that basically outside investors only have access to a cash account, a savings account at the risk-free rate, and they therefore have a Sharpe ratio of 0. Here that's the other, and therefore basically they are going to be paying lots of fees in order to join this superior asset. Here they've got the same kind of Sharpe ratio as the lead investors, and that's equivalent to saying that basically, they're just as good, or alternatively that they have all the bargaining power and that the lead investor can't extract any rents. So you can see here that if they have no bargaining power, basically most of the weight, lambda weight, goes to investor 1. So what we have here is investor 1 has a coefficient of risk aversion of 0.8, investor 10 has a coefficient of risk aversion 9. Everyone puts in, say, 10 million, and then this gives me my lambda weights set by the social planner, and you can see that basically the lead investor will have almost all the weight, because the other guys just have access to a savings account, whereas this project here may give, say, 15% expected return. What that means is that also the net worth of this lead investor will jump up from 10 to 65, and everyone else's net worth claim goes down. You can see that the most risk-averse investors, they sacrifice the least, because they are the ones who are the least keen on this risky project. It's the guys who are least risk-averse who are willing to sacrifice the most, because they are keen to take on some risk, and they currently only have access to a savings account. Here we have the other polar case where everyone has access to the risky assets. And then basically you can see the premiums now are 0, obviously. Everyone then has a net worth stake still of 10. And you can see that the weights are now more equally distributed. But again, here the most risk-averse guys will have less of a weight. And the bigger weight here is actually associated with investor 3. So it's non-monotonic, these weights. So let me conclude by giving the empirical implications and the conclusions. So we have a model that basically tries to derive the optimal investment policy for private firms, where we have a small group of investors with different risk preferences who can't trade in the firm's shares. So they kind of have to find another way of reconciling their preferences. Now, we found that actually, ultimately, the global policy is very much like a weighted average of the individual policies, which is very much in line with the diversification of opinions hypothesis. Yet, we've shown also that if things go really well, or really badly, you get polarization, in the sense that the firm starts to behave a bit like the least or the most risk-averse investor would run the firm. And so it kind of, to some extent, reconciles these two hypotheses in some way. We show that even though each individual investor has a constant level of risk aversion, the level of the group risk aversion is going to be time varying. We also have time varying leverage. It's procyclical. So the firm is going to ramp up leverage in good time and decrease leverage in bad time. And that's the way to survive. Because if it didn't do that, the firm would end up going bust. So initially, small startups may be primarily all equity finance with a net cash balance, and then as it grows, you ultimately start going to firms that end up perhaps being levered. We show that the optimal claim structure is quite complicated. It's like a mix of preferred stock and equity, and there is also debt in there. And as I said before, these kind of claims are tailored to the risk preference of the individuals and are a way to kind of circumvent the fact that you can't trade in the shares of the company. So you get quite a sophisticated liability structure. We've shown that basically the way you can solve this problem and the way you can construct the optimal policies is by modeling it like a social planner. Someone there at the top who decides in the interest of all the investors and comes up with capital structure and payout policies that basically reconciles the preferences. The results look quite different from what you would see perhaps in a standard corporation, whereby you may have, one share, one vote, where you may have dividends proportional to the number of shares you have. Here it's quite different. This being said, sometimes companies also have different types of shares. You could have dual class shares. You could have preferred stock. So there is also some variety we see out there, are warrants in corporations even. But on the whole, it looks kind of somewhat different from what we may be used to. Exception will be, as I said, if investors have lock utility. And yes, so this is the way how risk preference can be reconciled. And as I said, investors, when they join a firm, they may have to pay a premium, a joining premium, and that could actually lock them into the firm, even if they could liquidate their net worth. In reality, you usually can't, because they would have to start selling land and property, so normally you're locked in. But even if they could liquidate their net worth by having, co-investors with deep pockets, they wouldn't want to do so. Okay, that's all I wanted to say. Thank you very much.
Thank you, Professor. Thank you, Bart. Thank you very much for your presentation. We have a few minutes for any questions, either from... Is there any other mic? Or have you only mic here? There's another mic there. Richard. And just pass on.
Thanks, Stephen. Richard McVie from LSE. Very interesting, but there seem to be two elements to it. One is what a firm's actually like, and the other is what could they be like. The history of private firms in most economies is that they are family firms, and the rights of the respective participants depend mostly on family history. But this is about designing a new startup, which would be, they're increasingly common now, but probably historically, most of the existing firms, I would imagine, are still family-based. On the theoretical side, I mean, I'm not very good at this stuff, but something rang a bell with your ideal social planner. Isn't he going to run into Arrow's impossibility theorem?
Well, the impossibility theorem would typically refer to like voting protocols, right? That it is very hard to come up with voting protocols that will satisfy all investors' preferences. But here, we are not kind of designing some voting protocol. It's really, there's a social planner there that is trying to design policies that are in the interest of all the investors. So what we had was initially like a decentralized problem where everyone can do their own thing. And then we are moving to a centralized problem where there is someone who acts in the interest of everyone. Now that obviously does require that investors are happy to have this policy implemented, but there is no reason in our setup why they wouldn't, because it's exactly doing what they would want to do. Now, the thing is, of course, once you have more and more investors involved, I could see that perhaps it may become more difficult to take into account everyone's preference. And in principle, there is nothing here that stops us from having 100 investors. But to elicit everyone's preferences and to keep all of that in check may actually be difficult. So that's why then at some point, there would be a natural step to go public, to move to a corporation, not only because investors may want to cash out, which is one reason why you go public, but also because it would, for this social planner, become more and more intricate to kind of reconcile the preferences of more and more people, and particularly to be able to elicit these preferences. But yes, so there are, of course, certain assumptions that are being made here, and yeah.
Okay, thank you. I think there's a question to Neil.
Yeah. Hi. Yeah. Sorry.
Okay. Bart, can I ask, so my question's going to be, I think it's going to be about the hold-up problem, right? So I think what I've got in mind is a new project comes along, which is a discrete new project, and then needs some injection of capital, right? Is your model of the private firm robust to that kind of shift? So in other words, there needs to be more capital put into the firm, but it's history dependent on the shares that have already been allocated, but this might be an opportunity for some of the shareholders to then basically threaten the entrepreneur that they won't put any money in unless they get a renegotiation on their existing shares.
So there should be so yes, it should be possible to basically reset, but everyone's weights would have to be reset. And you would basically restart the problem. So what you would have is we have a net worth stake for each individual investor here in the firm. We can actually calculate that. If the firm has 100 million, there are 10 investors, I can actually track each individual's net worth stake dynamically over time. Yeah, so to make it simple, suppose there are only Ian, you, and me, and we start off with 50 million each. Over time, say you're less risk averse, your stake may have gone up to 60, the firm may have now done well, we are at 200 million, and rather than 50-50, you are at 120 million and 80 million. That would now be our starting point of the net worth stake we have. We now want to expand the equity of the firm. Some other guy is going to put in 50 million. So we would just restart exactly the thing. So you would put in now 120, I put in 80, the other guy puts in 50, and we solve for the new weights, and everything should basically mean that everyone should be happy in the way it's set up. So it is robust to new capital inflows, yes. And the key thing is that the model, basically one of the nice things is that we can actually calculate at each moment in time the net worth claim here. This is basically the stake you have as a function of the net worth. So at each moment in time, I can track this hypothetical net worth claim. And on the basis of that, we can always restart the whole process.
Thank you. Atul, sorry, I didn't see you.
Yeah, that's okay. Thank you. Hi, Atul Shah, City University. Mine is a slightly philosophical question. We just had before you the Dean talking about the core importance of sustainability, given the climate challenge. And we have plenty of evidence that economic theory and neoclassical economic theory has been a major part of the problem because environment has been an externality. Now, when I look at your model, and I know a lot, and I've just finished a book on the diversity of finance practice, on the ground, and especially the small family-owned businesses, and this is an extension of what Richard just said, they are extremely diverse. And yet, when I look at your paper and your theorization of it, you are doing exactly what economics has done for the last 200 years, which is to impose its own worldview, its own model, and its own universalist idea on society, and leave the damage of society to everyone else to deal with, right? So why are you not innovating in finance? This is very, very depressing to me, I'm sorry to say. Thank you.
Okay, so first of all, I should say that my model is in no way trying to be prescriptive here. Yeah, it's in no way trying to say how firms should be run or how firms should behave. It's trying to perhaps come up and try to understand to some extent what is going on. Yeah, it tries to explain to some extent what might be going on. Now, of course, every model is a simplified version of reality. Yeah, and I can point out lots of shortcomings of what we are doing here, and lots of assumptions that may not necessarily be always hold. But it's one way of, yes, trying to get some understanding rather than, sticking our finger in the air and trying to come up with some wild guess. Because if we don't have any kind of models to guide us or to guide empirical research, we are skating on very thin ice, right? Then you just start having empirical research that is based on wild hypotheses that are having very little theoretical foundation. It's hard to see how all of this consolidates. And so, although I admit that finance has its weaknesses, it has in certain areas been remarkably successful. In particular, while some of this work is linked to, say, pricing of derivatives, pricing of financial contracts, and so on. Whatever one may say, these models do work pretty well in reality. They are pretty good at explaining the prices that are out there in the market, at least for some contracts. Economics has had some successes. Look at auction theory. It's been pretty good, the way auctions have been designed to, with certain objectives to suit governments and so on, and maximizing proceeds. There are areas, I think, where neoclassical theory and so on has been successful, but there are other areas, admittedly, yes, where it grossly fails. And more work needs to be done there, and particularly, yes, to acknowledge the idea that there are issues about sustainability that are usually not taken into account by individuals. And we have the problem about long horizons. People just kind of tend to look in. But that's something that perhaps theory could look into and try to look a little bit more at long-term issues, overlapping generations, externalities that are imposed. So I don't think as such that it is economics that is at fault. It's perhaps the way economics is being used or misused.
Okay, thank you. Thank you. I think we've reached the time. Thank you very much, Professor. Thank you for your talk. Please. Great. We'll move on with the program. A little bit late, but at least we managed to have some questions, and I hope people online were able to also attend. So before we all split up, we have the 12 to 1 session on meetings, special interest groups, and all of this. Can I just mention again, this morning I didn't perhaps say this very clearly, the conference online platform, that you have all login and an access to, gives you all the details, all the locations. So whenever we have an update or we have a change, it's going to appear on the online platform. So please try to use it to try to find your way. And otherwise, have a good next of a conference. Thank you very much. Thank you. Professor. And here's a gift for, oops, sorry. Here's a gift for you. Sorry, it's just broken now. Thank you very much. Thank you. Sorry, I forgot about that.